Hello ladies and gentlemen, and welcome to another video from Swaraj Finance. I was particularly keen to make a video this week just because we had a very interesting end of the week in terms of market movements, and also because this was the first week of the third quarter. So we've closed off the second quarter of the year, and the quarters, because of financial reporting of the big investment firms, the quarterly transitions tend to be occasions in which there's significant shifts in the markets. So this was the first week of the third quarter going into July. And as I said, there were some interesting movements towards the end of the week. So we're going to be taking a look specifically at the commodities markets because, as many of you will be aware, this is the areas in which we see opportunity and in which we have our model portfolio heavily invested in the commodity space. So without further ado, I want to take a look at the oil chart first. And this is the daily candlesticks. And so you can see we've been a very clear downward trend since the highs of March and say June. We had a double top formation in the oil price in 2022 with the Russian invasion of the Ukraine. And since then, we've been in a downward consolidation phase for more than a year now. So what you can see is there's been strong resistance under the oil price at around the $67 level, and every time we hit this we bounce up, but in order to have a change of trend and a reversal to the upside, we really need to see a higher high being produced in the chart. So we want to see a new peak above this level, which is around $83. And we had a marginally higher peak in April when OPEC announced its first round of cuts this year. We had a marginally higher peak, but we quickly came back down again with strong, you can see the big red candlesticks, which was showing strong selling pressure in the oil futures market. And yet we've failed to break below this $67 level significantly. We spiked back down, but again, you get buying pressure. So oil has been reluctant to go below this, and also reluctant to make a significantly higher high above 80. So we've been in this range of fairly low volatility for oil. And as you can see in this formation, we're coming to a point at which something has to give. So either we break below this red trend line and we go down and we have a lower target at between $55 and $57 if we do break down, or the oil price breaks up and we break the downward trend and we start to move onwards and upwards. So we're coming to this convergence point, and I think over the next quarter we will see oil breaking either to the upside or the downside. So that's something to look out for. But as we moved into this first week of the new quarter, the end of the week, so the last day especially, you saw an almost 3% rise in the oil price. So typically when a day or a week or a month or a quarter ends strongly, the implications are good for the particular instrument being discussed. So when you have a strong ending to the week, in this case, it's generally a good sign. So although we've had this strong selling pressure over the last months, and we've had a kind of strong bounce towards the end of this week, which was interesting and coincides with a few other things that we'll look at today across the different markets. So some interesting signs. I still think there's a possibility that we do break down because we've had this low volatility period where we could still well see this break to the downside and $56, $57 target if we do. But this week ending strength in the oil markets was interesting, and I think it's made me question. I had a slightly higher probability on the breaking down thesis. However, if we see a continuation of this, we could well break to the upside. And summer is typically where more travel happens, more people are driving, more people are traveling around, and so in the northern hemisphere, in the US and Europe, and so on. And so that could be what drives oil to the upside. So that was oil. If we take a look at natural gas, we've also had strength over the last few days towards the end of the week. And I think if we take a look from a longer term perspective, looking at the weekly candlesticks, you can see I think we're in what's now an upward trend. And we've had the first wave in the natural gas price. We've come all the way back down from almost $10 back down to touch almost two, and I think we've formed a low here for this for the next wave upwards, which could see us back up at least to the halfway point, probably $5, if not 10 in the next wave. We could break above 10. We could hit 11 potentially even. So that's natural gas. Again, strength towards the end of the week. If we take a look at the precious metals and gold first, I've got some annotations on here just because I included this in the last quarterly report that you can purchase for non-members via our website if you're interested. So in our quarterly report, I'd highlighted the fact that we've had these 3 attempts to break through this red line around the $2,060 level on gold. And yeah, so this very clearly indicates that I think on the 4th attempt we will be breaking through. It's quite typical to have the 4th attempt being the successful attempt at a breakout. And we've also, you can see on this chart, we had a breakout of this blue flag, bull flag pattern in March of 2023. So earlier this year, we had a breakout. We tried to break through the highs for gold. Then we had what was I actually predicted in one of the videos that we put out earlier that we should expect to see a retest of this this blue descending trend line. It should become support, and then we should see a continuation to the upside after that. So we've had this retest. In our opinion, a great entry point for the precious metals miners at current levels. Fantastic entry point, in our opinion. Obviously, this is not to be taken as investment advice. You should do your own research, but in our opinion, it's a great buying zone for those particular companies. And if you want specific advice, you can subscribe to our portfolio insight service, where you'll see which companies we particularly like in that space. And so, again, if we look at the daily candlesticks on a closer time frame, you can see that this trend line is was broken. It's been acting as support, and we had a strong end to the week. Green candlestick back above. Also, this this rising price channel that you can see. So we're back in there, which is also positive. So exciting things, I think, for precious metals coming up this quarter. We don't know what news events will be the triggers for the price action that we anticipate, but it could be more inflation. The BRICS nations are announcing a new gold-backed currency, which is huge repercussions for currency markets and for the precious metals, the monetary metals like gold and silver especially. Russia, China, India, and Brazil and South Africa, the BRICS nations will be announcing this at their summit in August. So it's already been forecasted or telegraphed, say, by the Russian media already. But a formal announcement is probably due next month, and that could be a major trigger, which really sends gold to the upside, having a new challenger to the dollar monetary system through a gold-backed BRICS currency. So it's really exciting times in which we live. Silver, if we take a look at silver, we should see a similar thing. Yeah, so I'll look at the weekly candlesticks first. Again, we had this bull flag pattern forming. We broke out in March. We tested the previous peak, which was around the $26 level. We came back down, did a retest. We came back briefly below this price channel. But again, these last 2 weeks, we've come back and we've arrived at the top level of the price channel, which means, again, we're seeing support here, buying strength towards the end of the week, especially. So you see a large green candlestick, which engulfs the previous red candlestick. So, yeah, I think there's some interesting things to come with the precious metals. We can take a look at the gold-silver ratio as well, just because that has specific insights with regards to the outperformance of gold versus silver or vice versa. And if we see on the weekly candlesticks, we've been in this consolidation. So gold came up, made a new high against silver. So we had silver at 120 ounces for 1 ounce of gold. So gold outperformed up until March of 2020 during the crisis, and then the COVID crisis, and then now we have strong outperformance of silver, some consolidation again, but you can see lower highs being made, again lower highs, again lower highs, and I think we've been in a bearish flag pattern. So you can see gold has been outperforming, and now what we're going to have probably is a period in which silver outperforms, which is a general bull market for precious metals. So whenever precious metals are outperforming broader markets, commodities are outperforming, you tend to see silver outperform gold. It's a more volatile metal relative to gold, and so I think we're going to see silver break down. We're going to probably test this 62 ounces of silver to gold level, and then probably around 50, and then eventually perhaps 40, which would mean strong outperformance of silver. So now we can take a look at the dollar, which is important. If we look at the dollar index on the log scale, it's important because dollar strength tends to imply underperformance of commodities, and when the dollar is weak, that tends to be a period in which commodities, as they're all priced in dollars, commodities have a kind of tailwind behind them and they start to outperform. So again, a little bit like the gold-silver ratio, actually, you see lower highs in the dollar index. So this is the relative strength of the dollar against other currencies, and you can see dollar is failing to make higher highs. We've hit the peak of this channel. So the dollar is in a bull market relative to other currencies on the whole, but within this price channel, it hit a high of the upper level of the price channel, and so it'd be quite reasonable to expect the dollar to head lower and come back to hit the lows of this channel, probably somewhere between 95 and 100 perhaps, and that would mean the next leg down in the dollar would probably coincide with the breakout of the precious metals. So again, as commodities showed strength towards the end of last week, you had this strong downward pressure in the dollar, so weakness in the dollar. We can take a look at the copper price again. A strong end to the week. Copper, I'm kind of undecided on whether we're going to come back down and test this big arc pattern which we have. So this is looking at the monthly candlesticks. You can see on a longer term perspective, there's an arc being formed since the highs of 2011 up to the present, and we could fall a little bit more on the recession fears that seems to be quite prevalent in investor sentiment at the moment. But yeah, it's hard to say. We could this could be the lows already seen in November of last year, and we could be heading upwards. I think the next target on the upward side, I would expect to see $6 copper in the next peak probably, and potentially much higher over the next decade. So that's the copper markets. I think it's important to look at the yield also on the bonds. So we had a significant breakout. You can see on a long-term perspective, this is the 10-year US government bonds. You can see we've been in this huge downward trend for bonds over the last 40 years since the early 1980s. And during the COVID crisis, we had a breakout of this trend in that coincided with the invasion, Russia's invasion of the Ukraine, a breakout of bonds to the upside. We came back, we retested in August of 2022, and we're continuing onwards and upwards. We've had some consolidation over the first part of this year, and now strength in the yields, meaning interest rates are going up even higher. So you can see that on the daily candlesticks here. We had a kind of period of consolidation here, and we've broken, just in the last few days, we've broken to the upside in the first week of July, and we're above 4% on the 10-year yield, and I think we could expect to see even higher rates as inflation probably starts to turn up again for the second wave of inflation. So bond yields are suggestive of investors starting to anticipate higher inflation following the disinflationary period which we've had, in which the first wave of inflation has come back down, but we're going to see a second wave, which is what we've seen in the past. So the bond markets, which are really the biggest markets in the world, they're starting to anticipate that, I think, and this is why the long-term debt, the 10-year US bonds, are starting to demand higher interest rates being paid on that debt to counter the inflationary forces. Bond yields tend to be correlated to oil prices. So as this starts to tick up, I think oil is also going to start to tick up. And we had a look at that at the beginning of this video. So there's lots of signs that we might have seen the end of this period of consolidation in the commodities markets. And if we look at the CRB index, the Thomson Reuters Commodity Index, you can visualize the I think that's yeah. So on the commodities index, you can visualize this period of consolidation, and potentially this might have just ended, and we've certainly broken it seems to have this strong period of this strength in the commodities markets here, and so we could start to see the next upward leg in the commodities markets coming soon. Who's to say? We can't be sure of that. This is just a speculation based on recent price action and the strength that we started to see in the third quarter of the year. But it's very early days. We could still see further downside if a recessionary data comes in. It's hard to say. with any uh, sense of conviction, but it's a weight of probabilities analysis. We try and weigh up what's the more likely scenario, and certainly we see the upside in commodities being very outweighing the downside. I think fears of recession are there because of the slowing demand, which has come about due to higher interest rates. However, this is countering interest rates only rise to try and suppress the demand, but the demand is coming ultimately from a strong demographic perspective. So you have the millennials at the peak of their economically active years, as well as the Gen Z generation now coming into adulthood, graduating, entering the workforce, moving out from home, needing accommodation, and so you have pressure on the property market. And to slow that, we have this response in interest rates. So these are all things to consider when considering your own investment portfolio and your own decision-making process. We're here just to offer some insights, some ideas, some opinions. But like I said, you must do your own due diligence. And if you are inclined to subscribe for more of this kind of information, detailed reports and articles on our premium articles on our website, then do take a look. You can visit our website via the link in the description below. Very reasonably priced subscription service where we offer our opinions and analysis. So with that said, I hope you have enjoyed the video. Please like the video, share with anyone who you think might be interested, and subscribe to our channel. And we'll see you again for another video soon. Thanks. Take care. Bye.